GM, good morning. Welcome to the Milk Road Show, the daily crypto show where long term sometimes means lunch break. I'm your host, Jay Hamilton. It's Thursday, August the 27th. What do you need to be looking out for this week? Things are happening today, on Thursday, on Friday. We're actually recording this on Wednesday. When are we going to get an altcoin season? When is that going to, have we already got an altcoin season? Where are we in the phases of altcoin season and Bitcoin dominance? When is this cycle going to peak? I know that's on everybody's mind. And how do you plan for the cycle peak? How do you plan around that? And how will this cycle play out? These are all the questions we're going to talk about today. We are joined once again by Jesse Eckel, founder of Unpack Venture and fellow podcaster, YouTuber, and avid crypto investor. He's been in the space for a while. He's done it all. He's made millions. He's lost millions. So he's seen it all. We're going to jump into all of that. Before we jump in, if you guys are making swaps, you want to check out Milk Road Swap. Not only because it's my product and I love it and I have to show my own product, but honestly because it has some of the lowest fees in the space. You could swap at swap.milkroad.com. You can swap on Ethereum, Base, Arbitrum, Solana, all in one place with fees of honestly like 0.15%. It depends on the swap you're making, but it's usually around that. And you really can't get fees that low in many places in crypto. So check it out. Today's episode is brought to you by Figure Markets. Grow your cash like a bank. No lockups, just real returns. It's also brought to you by KGeN, the verified distribution protocol, changing the growth game. With that, Jesse, welcome back to the Milk Road Show.
Good to be back on the Milk Road Show.
always a pleasure to have you on, man. Okay, let's start. We haven't had you on since June was the last time we chatted with you. Give us your summer update. How are you feeling right now about the markets and where we're at?
I mean, I'm feeling good about where we're at in the markets. The current seasonal weakness, I think, was, at least for me, it's been something I've been talking about for a while now. August and September are seasonally just typically weak months for crypto. And just like all assets, it's just typically like a weak part of the year. But, we've known that TJ rebuild was coming for a while now. Right now, that's coming out of the RRP. That's about to hit bank reserves in September. And on top of that, we just have just like a bunch of different dynamics in terms of like we were really leveraged up in terms of Bitcoin. A ton of leverage had been built up. We went all the way to 124K. It was just time for us to kind of have a healthy cleanse, come back down so we can reload and get ready for October, which is when I expect, the real momentum to start beginning is around October.
Okay, let's in order to break down why you think the real momentum is coming around October, let's touch on macro, because I think that a lot of your thesis of why October has to do with macro, you've mentioned the seasonality, but let's talk about what is the macro setup that you're seeing right now?
Right now, kind of literally everything hinges on September rate cuts. At least the current picture is like everything is based around September rate cuts right now. It's fully headline driven market almost in a lot of senses, in that like we have a landmine of data coming in the next couple of weeks with like the PCE print on Friday. We have NVIDIA earnings today. We have PPI and CPI, I think in 2 weeks. We have JOLTS. We have a bunch of data reports coming out, and all these things people are using to determine, are we going to get a rate cut in September or are we not going to get a rate cut in September? And if we, right now the odds are really high that we are getting a rate cut in September. I kind of think unless inflation really comes in just crazy hot, no matter what, we're likely going to get a rate cut in September. It's just time. Like I think everyone kind of knows it's time. But yeah, everything hinges on that. If we don't get a rate cut in September, I think the markets probably nuke like crazy in September. But I still think regardless, we come back in October because people are going to say, like the nuking of the markets in September from not getting a rate cut will cause us to have to get a rate cut in October. Right. That's why I kind of feel like it's...
Is that almost a reason why they might need to do a rate cut? Let's actually back up a second. Let's talk about the recent conference and speech that Powell gave, because the market initially interpreted it as very dovish and felt very, very good about it. But that is not really what he said. I think it was just misinterpreted. Talk to us about what he said and why it got confused and what he actually meant.
So versus his last few meetings, he did salt it with a lot of dovish things. He knows that everyone reads into every word he says, and he said a lot of things that were dovish. My read on it was that actually didn't make any sense. Because going into it, I anticipated him just to be completely neutral. And the reason was because like if you kind of game theory it out, it makes no sense for him to give away his cards like this early. We got so many data prints between now and September that if he gets expectations in the market that we're definitely getting a cut in September, and like I just said, and we don't get a cut in September, the market dumps. That causes us to have to cut in October, because when the market goes down, everything weakens. Like all these things are like kind of reflexive off of each other. And so playing it neutral just seemed like the for sure what he was going to do, but he didn't. He solved it with all these dovish things, and I was like kind of left scratching. A lot of people were kind of left scratching their head. Everyone was offsides for that. And I think the reason he did it was because some of the framework adjustments that the Fed made were actually super hawkish. And actually, everyone on X saw the framework adjustments and also thought those were dovish, and like started going like giga, like, oh my gosh, we're going to the moon. This thing was floating around on X where everyone thought we were getting rid of the 2% price target, which was just
inflation target, right?
Yeah, which was completely. It was literally the exact opposite what they were doing, which was before this. Inflation could go above 2%, and that was totally chill. Like if inflation went above 2% and unemployment was bad, they're like, who cares? We're going to prioritize unemployment, which is why inflation went crazy high after COVID, because they weren't prioritizing it. They were prioritizing COVID. And after this, it's the exact opposite. Now they prioritize both kind of more equally. So if inflation is above 2% and unemployment's hot or looking bad, then they might still cut, or they might not, or sorry, they might still raise rates or not cut based off that, because they're going to prioritize both a little bit more equally now. So it's actually really hawkish in terms of like the market. And my thought was like, he probably knew that going into the meeting. And so to sort of offset or draw away attention from that, he kind of salted his language a little more dovish, and net, it would have come across neutral is, in my head, kind of probably how he planned it out. I think he didn't understand how stupid everyone would be. And now he's screwed, because now the market is like, oh my gosh, we're definitely getting cuts in September. Last I checked on Polymarket, the odds were still pretty dang high. And so I don't see how they don't cut in September. And then there's a whole just mountain of other stuff beneath that has nothing to do with him. That's all the Trump stuff, where Trump is stacking the board, and he is a man on a mission. Trump's determined about a lot of things, but like kind of maybe, under tariffs for sure. But like this is a pretty high priority for Trump, it seems, is getting rate cuts. And I think I even underestimated how high of a priority. But right now, if you're having to really bet against Trump not getting what he wants, if you're betting against no rate cuts, and this man, like he knows no bounds in terms of like going after what he wants. Like he's very, very bold. It's not like he's like kind of shy about these things. And so we had this week, he fired Governor Cook, which she said she can't be fired. I don't know what's going to happen with that. But he seems to be wanting to stack the Fed board with Fed governors who are dovish, as like a sort of a strategy, not only to get rate cuts, but also like as we have openings on the regional presidents. So the Fed board is made up of 12 members. And some of those members are from regional bank presidents, and they rotate in and out. There's 12 of them. And so anytime there's an opening, those have to be confirmed by the Fed governors. And so if Trump stacks the Fed governors in favor of doves, it has this huge cascade effect where like now those regional presidents are more likely to be dovish, and like it kind of reshapes the whole look of the board. And I think that's kind of his plan, because right now he's going after governors, but maybe soon he's going after regional presidents. Maybe he goes after there's actually one Fed president that kind of has like a lifetime thing. Maybe he goes after them, has them retire early. He can offer a carrot, he could offer a stick. There's a lot of different things he could do to kind of kick it the way he wants. But at the end of the day, barring like some Supreme Court ruling, I think Trump gets what he wants on this. And so I think we're getting a lot of rate cuts. Not just this year. We'll get probably 2 this year, but into 2026.
Yeah. I agree. And okay. I want to frame it 2 ways here. One is that I want to look at the next month leading up to the next Fed meeting and what data is coming out and what we should be watching for that would push rate cuts in yes, no direction. So let's talk about that first. And then I also want to touch on rates isn't the only thing that matters for obviously for markets to go up. The other, and especially when we talk about altcoin season, the other major thing is PMI and the ISM and what's going on in the business cycle. And that also is an important indicator. So first, let's talk about the next month though first. And what is coming up? You talked about we have PCE this week, then we got labor stats. What are you going to be watching for that would push rate cuts in either direction?
Okay, so basically you could really sum up the entire state of like, are we going to get a bull run? Are we going to get alt season as like pretty much any economic data that's bad is good because it just makes us get more cuts. So we like have a really solid response to any sort of bad economic data. So if you look at the business cycle and all that kind of stuff, it's almost like a secondary indicator because the core indicator is inflation. Really, like at the end of the day, if inflation gets out of control, that ruins everything because the government has a really solid set of policy decisions they can make to combat inflation. And all of those decisions are really, really bad for asset markets. And in terms of like if the economy is going under or whatever, they have a really solid set of like tools to deal with that. And all of those decisions are really good for our backs. And so, economic weakness and all that kind of stuff just means we're more likely to get cuts and all these things we want. But if inflation gets out of control, I like to give the example of like inflation is like sort of like Thanos, like any sort of like minor villain like popping up in economic data would be like, okay, we assemble the Avengers, we deal with this, and now we have the Avengers, right? And this is really good. Thanos comes along and then everyone gets wiped out, and that'd be inflation. So everything comes down to inflation. That's what we want to keep an eye on. So PCE, that's one of the core things the Fed looks at. And so if that comes in hot, that'd be really bad. If it comes in like kind of hot, that's not really the end of the world. But if it comes up like way above expectations, that'd be really bad. Any of these things coming in under expectations are fine. But probably maybe one of the biggest ones is PCE on Friday. So expect some volatility into the markets in Friday. And if that thing, depending on where that thing lands, like the market's going to rip one or the other, directions.
Mm-hmm, mm-hmm. Okay. And then the other ones would be labor stats in early September, as well as CPI and PPI we also have in early September as well. I can't remember the exact dates. And then I think the Fed meeting is the 17th or 18th.
16th through the 17th. So the FOMC meeting in September is going to be obviously the big pivotal point, but we'll kind of know which way it's going to go based on the current, unless they go rogue, which that'd be wild. But we'll kind of know based on these readings kind of how it's going to go. And Polymarket should be a good gauge of like, if you don't know what's going to happen, just look at Polymarket odds. You'll see those tilt one way or the other based on, Friday's read. And then CPI and PPI they'll be a big deal, but unless they're like really extreme, they won't be, in my opinion, as big of a deal as PCE, unless they come in like super cold. Like it's just, they're a lot lower than expectations. And that just really gooses the odds. And maybe we get a kind of a front run rally before the September meeting.
Mm-hmm. One thing I think that's important to understand too is like a lot of people, at least that I've been talking to recently, have been like, oh, rate cuts are inevitable. Like for sure we're cutting in September, right? And then there's this belief that like, because there's this, everyone's made that decision that this is happening, there becomes this belief that it's already priced in, right? The thing that I think everyone misses with rate cuts is it is not possible for rate cuts to be fully priced in because most major institutions that manage their money cannot do anything until the rate cut happens. It's after the rate cut happens that they can make a decision on changing their investments and going more risk on. So it is literally not possible for a rate cut to be fully priced in. In crypto, maybe because we're mostly retail. Well, I shouldn't say we're mostly retail right now, a lot of institutions, but we might have that feeling, but it's not possible because the money will move after the rate gets cut. So that's really why it would ignite it, I think, post.
That's a really good point. I think it kind of comes down to the dynamics of like how much fear and greed's in the market. If you have a lot of fear, a lot of greed in the market, then markets will do a decent job at pulling forward pricing expectations like that. So like if we were super over the top greedy right now, I could see a scenario where like people lever up and we really do kind of price forward that cut happening, because when everyone's that bullish, they just kind of assume everything's they're almost like bulletproof, right? And then when you do get the cut, like, yeah, you got those second and third order effects, but sometimes you can still have that kind of breakdown of price because it's too levered up. And at those prices, maybe those institutions aren't ready to buy because of it just ran too fast, too quick to the upside. But where if it's super fearful, then markets don't necessarily price it in at all. They might be like, yeah, but there's a good chance it's going to fail. And I would say we're definitely more in the super fearful camp. Like this market, it gets like bursts of like sort of greed, but like most of the time it's just like even those bursts, like we quickly retract because everyone's like still in fear mode. So I think exactly what you said, maybe it's like 10%, 20% priced in, but as soon as we actually get the cut, that'll be a huge confirmation. And then I think from there, it's just basically up only. We hit a new all-time high before the end of the year and things go really bananas into October, November, and December.
Why do people invest in real estate? Because it spits off cash flow. But I'm not here to manage rental properties. That's why I'm looking at Figure Markets. Their new democratized prime product backs your money with real cash flowing assets and returns up to 9% APY. It's the first real world asset borrow lend pool built for everyone, not just institutions. Ready to lend like a bank and get more than the 5% Aave is offering you? Download the Figure Markets app today and get 9% on your idle funds. Go to milkroad.com/Figure Markets. The best audience to distribute your product to? Your super fans, duh. But what if you haven't found them yet? That's where KGeN comes in. They help businesses scale digital distribution at a price that makes sense. KGeN's verified distribution protocol identifies the best users for your product and connects you directly to them. Ready to find real meaningful users for your next big product? Join the KGeN network today at milkroad.com/KGeN, spelled KGEN.
Okay, let's talk. I want to talk first. Let's stick with this year. I want to talk about cycle and your cycle thesis because you have a very interesting cycle thesis and when the cycle is going to end. But first, for this year, so your thought is Q4 we rip. Talk to me about altcoin season versus Bitcoin. What do you think dominates? Who do you think wins?
Really quick, I want to go back to you mentioned the ISM and like the business cycle and all that kind of stuff.
I forgot to.
Yeah, because with rate cuts and inflation and kind of how that ends up playing out, I think those are definitely important things. I think if you look at the business cycle, you can see that like for the first time since like 1948, we're just like sitting flat. We've never had an up wedge in the cycle. If you look at the chart, it's like I don't know what you would call that, but like waves. It's like a wave thing, up and down. And up until now, up until 2022, when the Fed raised rates faster than any point before in history, and it's just flat. Like the business cycle just went straight flat. We have not had any sort of business cycle since then. We've like poked our head above the 50 line, but that's it. And so the economy's in a really weird spot. And I've highlighted this before in that like, if you look at asset prices, they're at like all-time highs. Like the stock market's never been more overvalued in history. But if you go talk to normal people, they're dying. Like they're really struggling. I know a lot of people that 5 years ago their business was just like they were raking in money hand over fist, and today they're maybe going into bankruptcy. The average person is struggling a lot today. And so I think there's this weird disconnect in the economy. And you can see that in the ISM chart where we have not had that boom period, which really does come from credit, which comes from the lowering of rates. So when we lower rates, that gives us cheaper credit. Then we have this kind of boom period, this build out, and that kind of holds people over and allows them to kind of turn over that debt. We haven't had that up until this point. And I think that's a really strong indicator that like we need that. Like I don't see how we get around that happening. And it comes down to like, do politicians think that people are going to be more upset by inflation or more upset by being like really poor? And I think really it's a hard one, but I kind of think people are more upset by being really poor than they are inflation because I think they understand inflation a little bit less. But also, I don't know. There's just you kind of want to be making money, and so I think that that is like a really solid indicator of like we almost have to have that uptrend in the business cycle at some point. And so I don't know how it kind of ends up manifesting itself, but like it will at some point, because I think politicians step in and pull those policy levers they need to kind of kick the economy into overdrive, which is also what Trump investments say they want to do.
Yeah. Which again connects to the labor data that we're going to get in early September. And as you said at the beginning, that's the bad news is good news situation, right? Like,
oh yeah,
hate to say it, but basically we want labor data to come in September as bad so that the Fed and the politicians have no choice but to pull the levers they need to pull to kickstart the economy, which always drives asset markets higher.
Yeah. And, some of the levers they're talking about pulling, Trump keeps floating this idea. It was just a one-off. Like, he actually talked about it. Not a lot of people caught it. He talked about it like a month and a half ago. But now he's talking about it a lot more, which is stimulus checks. He's talking about sending tariff stimulus checks, taking the tariff money and sending it back to the U.S., to taxpayers. And the reason he's talking about that, if it's not becoming really clear, part of a pivotal part of Trump's plan is I think he understands that tariffs is a drag on the economy, and he has to goose the economy somehow and like heat it up. So he wants those rate cuts, but also like he's looking at alternatives like, okay, I can send out stimulus checks, because he needs the economy to heat up. We need that business cycle going. So there are so many levers. If stuff starts weakening, that the call for like the tariff stimulus checks will just go higher. That's what I'm saying. Like, yeah, bad news is really good news, because we're going to get just so many things thrown at us that are going to be really good for asset prices. And that really is the end game. I think the reason the asset prices are at all-time highs, even though the economy's really sucking right now, is because I think post-COVID, kind of the illusion of, U.S. Monetary policy, our debt, et cetera, kind of like faded, and more people kind of saw through the facade, and they're like, okay, wait, the government's just going to keep printing money into oblivion and inflate away everything that we own. And so I think more and more people are wanting to hold assets, and they're wanting to invest into assets. And it's not even necessarily about like earnings or anything like that right now. It's just about, I need to put my money somewhere safe from inflation, so I'm going to stick it in assets. And I think you're going to see that trend really accelerate. And that's another driver that's going to really push crypto higher over the next few years and into 2026.
I hope you're right about that. I hope you're right about that, because that is literally, you and I spend our entire day and our lives and our careers trying to educate people on this exact topic and help them make sure that they can build wealth and don't get stuck having their dollars inflated away. So I hope you're right, man. I hope you're right. If you're right, then you and I are doing our jobs well, because that's what we need. We need more people to understand that. I think as well, but there's definitely as you said, inflation is harder to understand, but it is becoming much more talked about, and there is more of a narrative around it that I think people are picking up on. And as a result, they are trying to figure out what the solution is. I'm not sure that everyone knows what the solution is yet, which is to go invest in assets, but they're thinking about it and they're heading in that direction. Let's talk about liquidity. That's the other piece of the puzzle here that we have not talked about. What are you seeing on the liquidity side?
On the liquidity side, there's a couple different things I'm watching. One is rate cuts, because that is going to free up credit and kickstart the credit cycle, which credit is a form of money creation. So like, more people taking out debt is more people making, like, literally creating money out of thin air. The other thing is they're calling it the enhanced supplementary leverage ratio is like the framework they're trying to put out, or the ESLR. And that's supposed to come into place in, I don't know. Actually, I saw something about maybe something even in September. But from my original expectation, it was like something by the end of this year. But basically, it allows banks to hold less reserves on their for like their loans. And so it kind of just, again, gooses like lend. It makes it so banks are more free to lend. Allows them to buy more bonds, and so as they're buying more of the government's debt, that like pushes down rates, and so that makes it easier to buy a house, which again, it has all these weird second and third order effects that really pump up liquidity. And so I actually think that's one of the most bullish things for global liquidity, like coming down the pipe. And then you have stimulus checks, and then you have all the other stuff other countries are doing too. Other countries are getting more like loose with their money, and they're kind of realizing, hey, this American exceptionalism, comes with them kind of running things hot, and so maybe we should be running things hot too. And so, I expect liquidity to go up into 2026. And you're actually seeing a lot more people saying that now too, that they're expecting liquidity to really go higher in 2026. And so this is part of my reason that I think that the cycle isn't going to end in 2025 like most people expect. But I think it's going to end in 2026. And I think there's a decent chance it doesn't just end in like January, February 2026, but that it ends up going all the way till the end of 2026. So it kind of in my head, the way that I'm seeing it play out is like a burst into early 2026. Then we have some sort of pause. I don't know exactly when that is, but like some sort of a breath period for the market to take a breath, and then a final run up into the end of 2026. And the reason I think we're going to have a final run up is just seasonality. Crypto seasonally just does really, really well in October, November, December. And so given the liquidity conditions and all that, I don't know. I see it playing into late 2026. At least right now. It depends how fast and how high we go into early 2026. Early 2026.
You might be the only one saying late 2026 right now. There's like the consensus that I'm hearing. The consensus I'm hearing is like early mid 2026, Q1, Q2 2026. Let's actually just talk about something though for a second. Why, this is going to sound like maybe a dumb question to you, but just for everybody, why is one of the consensus bets that it ends in 2020 in this year, that it ends in 2024? Why does so many people think that?
4-year cycle. People like patterns and they like to trust patterns. Even though the 4-year cycle is only played out 3 times, which is actually a really short pattern, it's hard for people to fade because it's been so consistent. And so basically everyone's anticipating that the 4-year cycle is going to play out like it always has, which would mean that the cycle tops basically October, November of this year.
Yeah.
And so, but most people think the 4-year cycle is built off like Bitcoin halving, and they have, or they don't even know why. And so they have these really simplistic models, which are kind of crazy. It's kind of crazy to think that way because, like you know it's going to break at some point. So maybe you should try to understand why it's happening. In my understanding of why the 4-year cycle actually has played out the way it has, it goes all the way to the 2008 financial crisis. And so you had it was a big thing that required a lot of policy response from lawmakers. Those policy effects actually kicked off the 4-year cycle with a bunch of debt and credit cycles that kind of all went in line that have played out exactly as you'd expect up until COVID, which was also a huge policy response moment that completely changed that pattern. And so you kind of can almost think of those patterns as like coming from a pivotal like economic disaster. And then like the policy response to that puts in place a pattern. And so that's why I believe we're in a new pattern in this. And I think it's going to be a 5-year cycle because it's nothing about this cycle is familiar to past cycles up until this point. Like it's really weird. Like everything is just off and nobody, quite understands it. All-time highs are being hit early. Credit cycle hasn't started. ISM hasn't ticked higher. Like all these different things you would expect to be doing well haven't started. And then even like the structural growth of Bitcoin is just way different. If you look at a chart, it's like the old ones are like these crazy organic looking spikes. And this has been like almost like this, I don't even know what to call it. It's just like it's crawling up just slowly on this like very man-made path or something like that. Mm-hmm. And so you have the structural bid from ETFs that has really been driving a lot of the growth in Bitcoin.
MicroStrategy and ETFs. That's what's driving Bitcoin.
Yeah. So everyone's locked into that 4-year cycle, but I think there's a lot of surface area to argue that like, why do you believe that? And if you don't really know why you believe that, then maybe you shouldn't be relying on something blindly that you're not quite understanding because, everything has kind of shifted post-COVID.
Mm-hmm. Mm-hmm. Yeah. I think it's very easy to get stuck in an echo chamber, and the crypto echo chamber of 4-year cycle is so strong. And there is a million TA analysts on YouTube and on Twitter that are giving you, and there's a lot of, look, I can make this argument too, so could you. There's so many fantastic charts where I could show you exactly when the cycle will peak this year based on, when it peaked the past 2 times, and it's within 30 days the past 2 times, so it's got to be within 30 days again, which is October, November, which is why we hear that so much. But I mean, the simple thing to me, and actually this was said on yesterday's show too, was it obviously the Bitcoin halving had an effect for a long time. Yeah. But obviously it has less of an effect now when most of the Bitcoin has already been mined. Like we're not talking about we're not talking about nearly as big of a supply shock as we were previously. And not to mention, as you said, the main thing is the financial crisis just happened to line up with the Bitcoin halving cycle. And that's just a coincidence, right? But I think that a lot of people are missing that in crypto.
Yeah. Well, also, if you go back and look on year-over-year liquidity, like global M2, like it lines up perfectly with all those cycles. So I really think the halving had such a little effect. If you go back to like the ETH's, the merge, Bitcoin's halving is 50%. The merge was like literally at one point over 100% because it was deflationary. And so like you would expect if a halving, like a supply shock really has a massive effect, back like 2 years ago, ETH should have skyrocketed. It should have just like gone to the moon based on that, but it didn't. It actually went down for years after that. And that kind of tells me those supply shocks don't have as much of a meaningful impact as people think. And that it really was more liquidity driven. But earlier, before we started the podcast, you were asking me like kind of why, or you were talking about like I'm one of the only people that thinks it's going to go into late 2026. Mm-hmm. And some of the reason behind that is actually from the structural belief of the 4-year cycle. So just kind of map this out in your head. Going into, we get this cut in September, cut in October, we just full send into, let's say we go into January, February, or somewhere around there, maybe even March. But by this point, like everyone's anticipating the 4-year cycle. And so you're going to just have, and all this leverage is built up. So you're going to have this structural sell pressure that's going to come into crypto as people are going to start trickling out because they're going to try to time the 4-year cycle. And so that's going to de-lever the market. We're going to have like some sort of mini crash around this point. But keep in mind, like the effects from the ESLR, the effects from the further rate cuts, I think Powell's out in spring. So it's like, all those rate cuts after that are priced in after that, not before. So all these liquidity dynamics don't come into play until the later part of 2026. So you have this sell-off where people are anticipating these things. And then you have all this liquidity that rushes into the ecosystem. So that's kind of why I think you're going to have like a pop into early 2026, a sell-off, and then a pop at the end of 2026 is because you get that second wave of liquidity where people are like, wait a minute, the party's not over yet. And then people really freak out. And that's what leads to that crazy blow off top going into late 2026.
Man, that would be crazy if it plays out like that. Crazy because it would just, blow off tops or nuts. But more so, it would be wild to get another double top essentially, right? Is what you're saying. I can buy it. I can see it. I think that one of the big reasons I can see it is a lot of we've had so much news this year from Trump, from the administration, from the SEC, the announcement that you can now buy crypto in your 401k, banks adjusting. We're still waiting for market structure. The Genius Act just passed. Like all of these things, the news has hit the markets and hasn't had an impact on the markets, but the actual action that comes out of these things won't come until 2026. And I don't know, early 2026, I don't exactly know when in 2026, but that is all of that catalyst is built up and is coming next year. And that really makes me buy into what you're talking about. You're smiling. Why are you so?
I'm smiling because you're right. We haven't even touched on all the regulatory freeing up and ETFs and like altcoin ETFs coming into play in October of this year. And then in 2026 it's going to be like bananas. Like the number of altcoin ETFs that are going to go for approval in the SEC is going to be too many. It's going to be ridiculous. And so, but like Clarity Act, I think that's like February or something. Unless we get it like really quick, it's like February. The stimulus checks are like spring. Like there's just so many things that point to 2026. That's where I'm like, how can you're literally having to hold to this 3-pattern cycle over like this just like mountain of evidence pointing to 2026. The only thing that could stop it is inflation. Inflation gets out of control, it's game over. And then maybe the other thing would be if we ran up too fast, too quick, we get that Icarus effect where we just boom, because you get too much leverage built up, and you have to correct at that point. So as long as it's a slow grind, like we have these kind of waves like we're doing right now, and as long as we don't have like inflation go bananas, I don't see why it doesn't go to into 2026. But inflation would be the one thing that would kill that. If inflation spikes up early 2026, then that's game over.
Yeah. Let's talk about how to play it. So obviously, let's focus on this year, how to play this year, because as you and I will both agree, we're getting you on the show more. We're going to be talking lots. The 2026 is still hard to predict, right? Like it is still far enough away. I think the play right now is playing Q4 this year. So how do you play it in terms of, I have two questions. On the buying side, how do you play it? What are you buying now, the time to buy? But then I also really want to talk about the selling side and exit strategy, because we talk a ton about what to buy. And I'm going to guess, I always want to get your takes on what tokens you like and stuff like that. But I'm going to guess that most of our audience is allocated already, right? I think you're at that point, right? So what I want to talk about is what's your exit strategy and how do you plan selling? Because that is the thing that the most people actually mess up and end up round chipping.
Selling is so hard because if you believe we're going to have a two-pronged cycle, kind of like we had in 2021, then knowing what to sell and when to sell it is really, really difficult. I say it's like individual per token. What you did have in 2021 is you had a wave of tokens. They were mostly kind of in the like thicker upper half of the market caps, right? So like you had a wave of like the blue chip tokens that did really, really well in the initial burst. And then the second burst was all the like low rung tokens that did really, really well. And so I would say but it's not exclusive. Like there were some low rung ones that did well, but typically in that first wave, when they top it, like they don't quite reach those heights during the second wave, but they do get pretty close. So maybe an easy one is, for like people to stay in profit is just sell your initial when you're in a double or triple, like sell your initial. It's really hard to lose doing that. Or if you think we're close to the top and you get freaked out, sell a third of your portfolio. That way, if we keep running, you have 2/3 in. If you're right, you got a little bit out early and you can sell the next third and the next third. You kind of have to have some sort of strategy like that, I think, to win. Because if you do those all or nothing strategies, like it just mentally is too hard. What'll happen is you'll sell it all in like December. You'll be like, I timed the top. And then we go higher in February and you're like, shoot. And so you buy higher. And then we dip into that dip I'm talking about and you're like, shoot. So you sell lower. And then we skyrocket again and you buy the top again. You see what I'm saying? Like mentally, it'll just screw you over. So like having some sort of like sell your initial or sell a third or whatever, that will save you from losing a lot of money. Most people still won't do it. You get too greedy, but like you kind of have to understand that if you act like everyone else in the market, you're gonna lose because the average person doesn't become a multimillionaire investing in the market. Like it's only the outliers that do. So you kind of have to you're playing rock, paper, scissors with everyone and you have to be whatever they're not. And that's investing. So
would that say, just going, I fully agree with just selling stuff, and I want to chat a little bit more about that. I think we're going to talk about that a lot on the show over the next few months, just because that is, everyone's got that question, right? Of like, when is the top? When do I sell, right? And how do I sell? And how to think about that. But the buying side is very interesting to me, because sort of what I'm hearing you say, and I'm going to really simplify this, so forgive me for making it this simple, is right now it's like non-Bitcoin major season. So it's like ETH and Solana, and pick your other leading, top 50 token, right? And then, and so that's this year, right? And maybe into 2026, as you said, maybe it goes Jan, Feb, March, right? Somewhere in the range of like Q4, Q1.
Not just Solana and them, but like just the blue chips. So like, Solana and, Sui and all these ones, they've been running Hyperliquid. They've been doing good. They'll probably continue to do even better. But like, think of the things under them. Like everything's a beta to a beta to a beta. So like Polygon as like a beta to, like right now it's been like 2017 era tokens that have done really well. XRP, all this stuff. And the 2021 darlings, I think, will also do well at some point. You'll have like Avalanche, Polygon, maybe some weird ones like what I forget what Phantom became Sonic or whatever, something like that. And then but it keeps spreading out like Uniswap, Aave, and then you also will have like narrative rotations alongside that. So it's not like it's just going to be blue chips, but kind of how we've had narrative rotations all bear market long, you'll have narrative rotations. One of those will be something AI branded. At all times, AI is going to have something. It'll always have a champion in the battle. And so AI agents was it one time, the like Tau like things was it at another time. I don't know what it'll be next time, but there will always be some sort of AI narrative rotation happening, alongside like a range of other narratives that kind of pop into favor, that will pull some of those lower rung tokens up to the top. And so you kind of have to either guess those, or I don't know. But the season for the really, really cheap tokens will be that second wave. Or if we don't get the second wave, it'll be at the end of that first wave.
The 2 week end of the euphoria moment. It's so fast. Like that season is so fast.
It is so fast, but you make so much money because they go up really high.
Yeah, totally. Yeah, it's it feels like a time where I keep saying, and I would love to end this with, sort of your advice that you're giving to your audience as well right now. But what I keep saying is just, patience is the key right now, right? If you have money on the sideline and you're not allocated, then I do think now is a buying opportunity. I think it's possible we dip lower than this through early September, depending upon what happens Friday with PCE and various macro data that we're going to get in the next month. But it feels like I think by the FOMC meeting, September 17th, if we get that rate cut and you're not allocated, it's going to be tough to allocate for Q4. So like now's the time to be buying if you have anything on the side. At the same time, I will also say you should always keep cash on the side, right? I would never fully allocate all my cash. Always be prepared for a black swan event or something like that hits you, blindsides you. But then I also think that, you really you got to be patient right now and don't get in your own way, because the mistake that most people make is, why isn't it going up fast enough? Why isn't it where I want to be? And then you start to chase narratives. And if you're a narrative chaser, let's say this, unless now go become a trader, if that's what you want to do, right? Don't just think, oh, I can now catch the next narrative. I'm spending time on Twitter. Like, I know what it is. I listen to a few influencers. You don't. You're exit liquidity. Don't make that mistake.
That's really good, because it does go. A lot of times the gains are made in like a 1 to 2 week period is like where like the meat of all the gains is made. So you do have to have that patience, and allocating now when you don't want to is often the best choice. When everyone else is telling you to allocate, that's usually the time you probably should be taking a little bit off the table. And so, I agree 100%.
Awesome. Jesse, pleasure to get you back on the show today.
Yeah. Thanks for having me back on the show.
Always good, man. I love the smile. I love the energy. Jesse's going to be joining us on a more frequent basis, so we'll see more of you. Thanks for tuning in all. I got to remind you now that today's show was financial advice. I'm not your financial advisor. Jesse's not your financial advisor. If you need help with your finances, just speak to an investment professional. We'll see you back again tomorrow. Have a wicked awesome day.
If y'all are making swaps or trades right now, highly recommend you check out Milk Road Swap. This is a DEX that we built in partnership with Cow Protocol. Why did we build it? Not to make money, just honestly so we could have a place to do our swaps for the lowest fees that we could find. This is the fees on Ethereum, Arbitrum, and Base are only 0.15% fees. This is a huge difference from other centralized exchanges that charge 0.5% or even up to 1.2% fees on their swaps. Also, you can swap on Solana, all at swap.milkroad.com. Check it out today. You won't be upset. And you can join me in my favorite place to make swaps on chain. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.